everyone, and welcome. My name is Leon Wessels, and I will be the moderator for today, as well as future sessions planned for 2020. For those of you who are new to our sessions and not familiar with our company, I will, today only, provide a brief explanation which will help hopefully all of you understand our choice in topics and our areas of expertise. I work for Life Insurance Trust Company, which is a subsidiary of Longevity Holdings, LLC. Collectively, we are the market-leading, technology-enabled providers of data, analytics, and services focused on our senior population. ITM 21st, Life Insurance Trust Company, and Fasano Associates provide life insurance policy servicing and trust administration services. We have an experienced team of life insurance experts to help banks, trust companies, advisors, and investors manage in-force life insurance policies. We possess huge amounts of proprietary older age data information, which includes medical information that will help our clients develop financial products for seniors and assess mortality rates. We are a leading medical underwriter for older ages and impaired lives for life insurance, life settlements, and structured settlements. And we are the only trust company focused exclusively on life insurance trusts. PBI, which is a death audit and locate services provider, identifies deaths for pension funds, insurance companies, government entities, and financial institutions by using integrated data sets, including proprietary obituary databases, artificial intelligence, and human expertise. We also, through PBI, provide locate services for pension participants and other beneficiaries. I want to welcome you to the restart of the ITM 21st University Education Opportunities. Thank you for registering and attending today's session. If you find your time well spent and the information today helpful, please share your experience with your relevant friends and colleagues, as we have room to accommodate up to 500 registrations per event. We are using the GoToWebinar platform for our session. Each will be recorded and available on the ITM 21st website under the Education tab. The phone lines today will be muted except for those who are listed as panelists or organizers. I encourage you to ask questions via the questions or the chat box that is on your screen. We have allocated 10 to 15 minutes to answer questions, so please help us by submitting them so we can all learn together. We are counting on at least a dozen or so questions to fill our time requirements today. We have Aaron Hansen with us also. Aaron is who leads our remediation group and is offered to address questions and or provide his thoughts at the end of our session. If you have a question that you do not want addressed openly, please indicate that when you submit that question, and Aaron will respond to you privately. If you have a tricky or simple issue, please just share it with us. We all want to learn from it. Today, our introduction will be a little longer than normal just because we're reopening these sessions. In the future, our introductions will be 5 to 8 minutes before we get into the content of the session. So as you can see, we're back. So slide 2. It's hard to believe that our last session was nearly 2 years ago. Thanks to all who have either called us or emailed us asking to bring these webinars back. We have been listening, and today I'm thrilled to be a part of the ITM 21st Educational Webinars 2.0. Slide 3, clearly everybody's seen this graphic. As we all adapt to the reality of working during a global pandemic, I would be remiss if I didn't say something about it. Clearly, the coronavirus pandemic has changed all of our lives. Our thoughts and prayers go out to those who have family or friends who have suffered from this infliction. We are also indebted to the millions of people who put their lives in danger every day to keep us safe and to keep us supplied with food and other necessities. Being homebound certainly takes its toll, especially those who are used to being active and on the move. If you sat and watched sap drip from a maple tree, you could easily fall asleep from boredom, for it feels that the single drips of sap will never amount to anything worthwhile. But if you walk away and let the bucket gather drips one by one, the bucket will eventually be filled with sap. Tap more than one tree and wait more than one day, and the buckets of sap will become gallons ready to boil down into delicious maple syrup. Now more than ever, we are learning about the power of your life, the power of how your life affects others. Staying at home and washing your hands feels like a small drip in a big bucket. But when everyone does it, the power of exponential growth is activated. This is a piece from Mac Hammond, who does the Winner's Minute on a daily local Minneapolis TV station, and I thought it was worth sharing. Slide 4, our continuing education and our credits. I want to speak to that for a moment. So for those of you who are new to this venue, we're really not a university, clearly, but we do provide learning opportunities. All of our sessions are free of charge, even for those seeking continuing education credit. All of our webinars are submitted for 1 hour of CTFA and CFP continuing education credit. For those of you who are members of the Fiduciary Investment Risk Management Association, we are pleased to inform you that the great people at FIRMA will once again allow its members to receive credit for our sessions. The FIRMA annual conference has always been one of our favorite events of the year, and clearly we were disappointed, along with many others, events this spring that have been canceled due to the pandemic. Hale Mast and the FIRMA board are fantastic people and great to work with. If you're not familiar with FIRMA, I encourage you to visit their website to learn more about that organization. You can find them at thefirma.org. To receive continuing education credits for today's session, please follow the instructions on the screen. Download the form from the ITM 21st website, complete the form, and return it to itm21u@itm21st.com within 7 days. If you have any questions about the credits, please send an email to the same address and someone will respond to you as quickly as possible. Slide 5, our webinar schedule. So on May 13th, we will have an insider's guide to life insurance in a challenging environment. This will be presented by Michael Brohan. On May 27th, our session is titled Minimizing Trustee Liability in a Changing Market with Judith Pearson. In June, we will have Aaron Hansen join Michael Brohan to review case studies and discuss how life settlements have been used in real trust-owned life insurance cases. And again, we will plan to feature guest speakers in July and August, and those details will be announced soon. Our faculty, I'm joined today by my colleague John Barkhurst, who will be leading today's presentation and whom I will be introducing in a few moments. In addition to John, we're happy to have Michael Brohan back on the program. Many of you know Michael and have enjoyed many of his informative sessions over the years. Mike was the person responsible for creating and sustaining the ITM 21st education program over 10 years. We are so happy to have him back. We are also pleased to announce the addition of Judith Pearson to the faculty. Judith will be presenting several sessions this year with a focus on fiduciary risk and trustee liability. So Michael Brohan, chartered financial planner, chartered life underwriter, and CAP, which is the American College designation for philanthropy, is a pioneer in the trust-owned life insurance world. Michael now works with trustees and wealth advisors nationwide, helping them to navigate the life insurance marketplace. His time in the Tolley world taught him the benefits of developing prudent practices to buy and sell life insurance. His ability to bring clarity to a confusing marketplace allows his clients to move forward with confidence. Michael has enjoyed educating peers about life insurance, especially in the trust, accounting, and legal community, and has been a speaker at numerous national events. In 2019, he published his first book, The Wealth Advisor's Guide to Life Insurance, and he's not claiming in his bio the credit for writing our Tolley Handbook, which is an outstanding resource many of you have downloaded, and if you haven't, you can get that from our website. So, Michael, would you just give us a 2-minute preview of your upcoming session, please?
Sure, Leon, and I appreciate the comments about coronavirus. You know, we've all been working at home, and sometimes we forget the human aspect of that. And as somebody who actually has lost somebody in my family to it, that kind of struck home. I appreciate that. About the course, first of all, this is a really interesting time in the economy, obviously, but for the life insurance industry, the coronavirus issue is just the tail end of 12 years of low interest rates that really wreaked havoc on the industry. So I'm going to review the issues with life insurance in my session right now. And if you're a trustee and you attend, you're going to be able to limit your liability, advise clients better, and in the process, increase your customer service levels by what we're going to talk about. We're going to review what's going on now in the life insurance world, and it has been changed fairly dramatically by what's going on. We're going to focus on how it affects you as a trustee or as a wealth advisor working with clients going forward. And I'm going to provide specific information on how to deal with each type of policy in your portfolio going forward. So if you're a trustee, you're going to know what to look for when you're managing your policies. I'm going to go over the one thing that trustees should all do to limit their liability, and I'm going to give you a step-by-step method of doing it. And then we're going to talk about some of the things you as a trustee or as a wealth advisor are going to be seeing now and in the next few years from your clients. And there, again, I'm going to give you concrete steps on how to deal with each item. So because there's going to be a lot of information and the takeaway from the session is going to be on the processes that I lay out, I'm going to be including a workbook so that after the session, you can refer back to that information at a later date. So I'm very excited about being back and being able to do these webinars. I hope you sign up and pass on the invite to others, and not just trustees, but CPAs, attorneys, family offices, anyone who has clients with life insurance is going to get something out of this session. So again, thanks to John and Leon and everybody at ITM 21st. I'm looking forward to it, and looking forward to a great session today. So thanks, Leon.
Thanks, Mike. Judith Pearson. Judith, a seasoned insurance industry and risk management expert, leads Nomadic Solutions as the president and CEO. Nomadic has an expertise in identifying, mitigating, and transferring risk for wealth transfer vehicles. Judith has been a frequent speaker and has been quoted in notable periodicals such as the Wall Street Journal, New York Times, as well as the Financial Times, and has written articles for Wealth Management and Trust and Estates magazine. Judith was named one of the 2015 Power 100 Leaders in the Art World by Blue Art Info International for her role as insurance innovator. And Judith, I welcome you to the faculty. I look forward to having you join us this year. And if you wouldn't mind, just give us a quick overview of your session on May 27th.
Well, thank you so much, Leon. And I ditto on all of the challenges that we're facing, and I'm really excited to be a part of the ITM 21st University. Identifying, mitigating, and transferring trustee liability was changing prior to COVID-19. However, all businesses and advisors have added pressures in the new normal. Understanding and adapting to these pressures is key to risk management. We will provide how the various demands have been changing, how to think about the different roles and responsibilities, how those are changing over time. And as we see the structures from moving from a directed to a delegated trust structure, how that impacts all aspects of risk management. In our presentation, we're going to discuss how to, through all these different pieces, how to minimize the trustee liability by understanding the roles and responsibilities, by understanding the changing market, and focusing on what are the things you need to be thinking about from an insurance perspective. And I hope everybody can attend the session, and hope it'll be informative and exciting for you to listen to. Thank you so much.
Thank you, Judith. We're looking forward to that in just a few weeks. So today, John Barkhurst. John oversees the new business development and account management for ITM 21st Trust Services Division, has been providing third-party administration and risk management solutions for trust-owned life insurance since 2004. Prior to joining ITM 21st, John was one of the original members of the Insurance Trust Monitor, ITM, and Insurance IQ teams. While at ITM, John's proficiency in life insurance was utilized in various roles in business development and operations. Prior to joining ITM, John served as Vice President of Sales for Insurance IQ and played an integral role in establishing Insurance IQ as a premier provider of life insurance analytics and ILIT software to banks and trust companies. Before I turn the meeting over to John, I want to share my moral of the story piece, which is called Frogs for Dinner. The story goes as this. A lady was once heating up a pot of water on a gas stove with the intent of cooking pasta for her family for dinner. A frog fell into the pot while it was sitting on the stove. While it wasn't his intentions to be stuck in the pot of water, he didn't try to escape as he was comfortable and in his element. The lady soon turned on the flame to begin boiling the water. As the water's temperature began to rise, the frog was able to adjust his body temperature accordingly and remained in the pot of warm water, thinking this is really pretty nice. However, as the water approached its boiling point, the frog's body temperature could no longer keep up. Once the water got too hot, the frog was unable to make the leap to safety because his muscles would no longer function and didn't have it in him to make the leap to safety. It was too late for the frog to save himself. The moral is that things don't always go as planned in life, and they certainly don't always go the way we want them to. But no matter how bad the situation is, it's critical to be proactive and face the problem head on. Unlike the frog, who waited until the last minute to try to do anything about the problem he was facing, it's important to project the future outcomes of the obstacles that hinder us and mediate them before they get past the point of no return. If you didn't know it before today, you soon will learn that insurance trusts don't always go the way they are intended, even in the best of times, not to mention during a worldwide pandemic. John Barkhurst is about to share some timely and useful information that will help you better manage your ILITs during these challenging times. Take it away, John.
Thanks, Leon. Appreciate that, and certainly thank you to everyone who's joining from all over the United States today. We appreciate you carving out an hour or so of your time, and hope the session will be relevant and timely. Like Leon and Mike and Judy have stated, certainly wish everyone safety and hope all is well during these unprecedented times. Like many of you, I'm joining today from my home office, which at this point feels more like my real office than my actual office, and I'm sure many of you can relate. At times, it's really hard to imagine what life was like just a couple of months ago. Many businesses worldwide have had to enact business continuity plans for the first time. These work-from-home strategies have really become the new normal, and obviously the rapid spread of this virus has impacted all of humanity. As wealth management and fiduciary service providers were not excluded from all of these challenges as well. During these challenging times, fiduciaries have a heightened responsibility to protect our clients' property and investments. Unfortunately, this is coming at a time when many of us are more focused on ourselves and our family's well-being, making a seamless transition to a well-prepared plan critically important. Our fiduciary duties are a 24/7, 365 responsibility in favorable times and also during times of adversity alike. Our clients have created thoughtful financial and estate plans to prepare for the sometimes unexpected, and they're relying on us and have entrusted us to carry out those plans. As we've stated, life insurance is really just one of the many unique and hard to value trust assets that we are charged to manage. However, it's probably the least forgiving in the absence of active oversight and management. Something as simple as a late or missed premium could have a significant impact on a policy's performance, or worse, result in a policy lapse. Now is definitely not the time to be passive in the management of our trust-owned life insurance. So in this session here in the next few moments, we'll discuss the 12 things that every ILIT trustee should be focused on right now to manage trust-owned life insurance, not only today, but in the coming months as we deal with the lasting impact of this pandemic. So the discussion will center around four main topics: fiduciary responsibilities for ILITs, trust administration, policy management, and client communication. Throughout the session, we'll offer some tips and insight from our experience managing tens of thousands of trust-owned life insurance policies. To reiterate, if you have a question, please use the question chat box in the GoToWebinar feature. Aaron will be recording those and will gladly answer and address any of those questions at the end even if they are specific cases or issues that you're dealing with today. We'd love to have the opportunity to use those as learning opportunity. So let's get started here. I think it's important to periodically remind ourselves what our fiduciary responsibilities are with respect to ILITs. It really is a unique trust arrangement. So the first thing all ILIT fiduciaries should be focused on now, and really always, is the fact that we have a duty to protect beneficiary interest. Remember that when we're serving as a trustee of an ILIT, our fiduciary duty is to the trust beneficiary, not the grantor, which is oftentimes the insured. This is certainly easier said than done because our relationship is likely with the grantors. A trust beneficiary is merely an unknown contact, probably just a name in our system, who we send a letter to on an annual basis to fulfill our crummy notice requirements. It's the grantor who we rely on for contributions to pay premiums, and it's the grantor who pays our trustee fees. We may even have a broader institutional or wealth management relationship with our grantor clients. So keeping them happy is very important to us, and rightfully so. But understand that with respect to an ILIT, the grantor is to have no incidence of ownership. What does incidence of ownership really mean? Well, it means that the grantor should not be making or influencing decisions as if they were the policy owner. Because the policy is owned by a trust, this is our job as the trustee. Again, easier said than done. We have here at ITM 21st seen an uptick in calls from grantors in the last 6 weeks, and it really will only get more prevalent in the coming weeks and months and years as the financial impact of this pandemic is realized going forward. We've had numerous conversations with grantors wanting to skip premium payments this year or indefinitely, or grantors wishing to take policy loans to take premiums. We've seen an increase in grantors' desires to surrender policies altogether because they feel that the policy or the trust is really no longer needed. If you haven't had some of these types of conversations yet, you will. Be prepared for these inquiries, as many grantors will begin to question whether they want or need to continue funding their insurance trust, or even continue the trust and or policy in general. Be prepared to discuss policy details and the consequences for inadequate or discontinued funding. As trustees, we must consider all options in a timely manner to protect the interests of our true client, the beneficiary. Ultimately, the decisions that we make as trustee may align with the grantor's intentions, but we must be careful to make these decisions only after a prudent process was followed. Transitioning now to some points on trust administration, I think it's reasonable to expect grantors and beneficiaries alike are facing increased financial and health challenges and consequences resulting from this pandemic. So this makes even the most routine of ILIT administration tasks more challenging. We'll talk about a few of these now as it relates to administrative responsibilities, and with each I'll offer a few tips to help ensure nothing falls through the cracks. The trust administration process, as many know, typically begins with the mailing of a gift notice to the grantor. In this letter, we are requesting a contribution to the trust so there are funds available to pay the upcoming life insurance premiums. Most trustees also request payment of their annual fiduciary fees as part of this gift notice process as well. We all know the clients who are habitually late gifters. I think it's realistic to expect this to continue and likely increase as grantors begin to realize the impact of this pandemic and deal with the realities of their individual situations. If possible, I think we should provide grantors with extra time to contribute to pay policy premiums. Send gift notices out sooner than we have in the past. If our standard operating procedure is to send these letters 60 days in advance of premium due date, consider 90 or even 120 days. Remember, the earlier we can identify any potential funding issues, the better we can evaluate and analyze the options to determine the best course of action for a particular policy. Now, it may not always be possible to know premium due amounts this far in advance. An example of this is in a whole life policy situation where premiums are dependent on dividends being used to reduce the amount of cash to be paid out of pocket. Dividend information is typically not available from insurance companies until approximately 21 days before the premium due date. However, this is likely not the first year of this dividend offset strategy, so the grantor should realistically understand the time sensitivity of this. This should not stop us from communicating early with the grantors, reminding them of the need to make an upcoming contribution. This communication can occur formally by sending a gift notice with an estimated premium due amount as a placeholder, or it can be done through an informal phone conversation with the intent to send an official gift notice at a later date. Bottom line, when the actual premium amount is known and ultimately communicated, we don't want it to be the first time that the grantor is hearing from us. We should be giving them ample opportunity to be prepared and make a timely contribution. After the contribution is received, obviously we're now charged with the task of sending crummy letters to the beneficiaries. For most trustees, this has been a simple check the box exercise for many years. We send out these negative consent letters, we wait the specified period of time, we don't hear from the beneficiaries, and we don't really expect to, and then we move on to paying the premiums. What's the one thing that could really complicate the process at this point? That's right, a beneficiary exercising the right to withdraw their specified amount of the trust contribution. Have you ever had a beneficiary exercise the right to withdraw? If you haven't, it's probably just a matter of time before you do. Here at ITM 21st, we've seen an increase in the number of inquiries from trust beneficiaries as well in response to their received crummy notices. The grantors are not the only ones being impacted financially by this pandemic. Be prepared for conversations with trust beneficiaries who may for the first time decide they want to withdraw present-day gifts made to the trust. Much like in the scenario earlier with grantor funding questions, it's important to have a process for evaluating policy options in the event of insufficient funds to pay policy premiums. And most likely, this process will involve a call to the grantor informing them of the beneficiary's request. But here are a couple of things to think about prior to making that call or speaking with the beneficiary. Is the full premium amount required to avoid policy lapse, as in a guaranteed universal life policy or a term policy? Or do we have some premium flexibility? Is there sufficient cash value in a universal life policy to make a reduced premium amount this year? In the case of a whole life policy, is automatic premium loan, APL, in place in the event a loan is needed to offset a reduced premium payment amount? Knowing the impact of potentially inadequate premium to the policy will facilitate dialogue with the grantor and beneficiary and ensure a prudent outcome. The policy premium monitoring and payment process is arguably the most critical task for any ILIT trustee. A late or missed premium payment can have a significant impact on a policy's performance, or worse, the policy could lapse, ultimately resulting in significant fiduciary liability. The first line of defense in a successful premium monitoring and payment process is reviewing premium due notices as soon as they are received. Processing incoming mail on a daily basis and identifying premium due notices immediately is critical. If you're not able to process incoming mail because you're working from home, stressing the importance of this task to our administrative support team is imperative. Once the premium due notice is received, we should be reviewing policy information to verify the amount shown on the notice is enough to sustain current policy benefits. For example, the amount listed as planned premium on a current assumption universal life policy may not reflect the actual amount of premium needed now to sustain coverage. But we would only know this if a thorough policy performance review has been conducted recently. Whether we are relying on internal insurance expertise or engaging outside service providers for policy review services, as trustees, we must understand policy details and how each policy is performing to determine if alternative funding scenarios should be considered. The second point to make related to premium is this. When a premium payment is sent to the insurance company, call the carrier to confirm that the money was received and, most importantly, applied to the correct policy. The insurance companies are facing many of the same business challenges as the rest of our businesses, with operations and service centers adopting business continuity plans and their own work-from-home models. We'll touch on this more in a couple of minutes. But as it relates to premium, do not assume the carrier received and processed the premium payment. Confirm and verify timely receipt and processing. Shifting gears to policy management now, away from some of the trust administration points. Life insurance as an asset is possibly the least forgiving trust-held asset in the absence of active oversight and management. One simple miscue could have a significant impact on the policy's performance, or as I said earlier, worst case scenario, the policy could lapse. Here are a few thoughts as it relates to the management of life insurance in general. I think we should be prepared for an increase in carrier service request turnaround times. As we just mentioned, insurance companies are adapting to their new ways of doing business also. If you have called an insurance company in the last 6 weeks, you likely experienced longer than normal hold times as they transitioned into their work-from-home models. We should expect delays in service requests for the foreseeable future, especially from those carriers that are historically slow to respond or those that were only responding via snail mail prior to a pandemic. We've experienced some delays here at ITM 21st in death claim processing and preparing updated illustrations. So be prepared to adjust planning and expectations accordingly. A positive note, service times seem to have remained consistent for requests that can be processed electronically. So that's a great tool, that an advantage to requesting and receiving information electronically from the carriers that are able to do so. As a general best practice, when on the phone with a carrier, it's always a good idea to ask for an estimated time of service and make a note of when you called and who you spoke with. Dealing with these insurance companies on service-related matters is no doubt frustrating at times. If you've not reached out to the Grantors insurance advisor or the servicing agent as assigned by the carrier, perhaps now would be a good time to do so. They may be willing and better equipped to assist with illustration fulfillment and other policy servicing requests. Points 7 and 8 deal specifically with the industry's response to the COVID-19 pandemic. During these unprecedented times, most carriers are offering grace period extensions and premium deferral programs. It's important to understand what carriers are offering with respect to these payment flexibility programs during this period. For example, some carriers, say Northwestern Mutual, are giving a 60-day grace period extension upon request, while other carriers, like New York Life, have automatically put provisions in place to temporarily pause policy cancellations due to non-premium payments until a specified date. And that date is currently June 23rd for New York Life, but could certainly be extended. This is a great option for our grantors who are experiencing temporary hardships due to the pandemic, or if we just need more time as trustees to analyze and review funding options with them. Keep in mind, these are not payment elimination programs, and premiums will continue to be due. However, carriers are waiving late fees and penalties. If you have not received correspondence from a carrier regarding available temporary relief options, and a premium payment is likely not feasible by the original due date, call the carrier, speak with the carrier or the grantor's insurance advisor if possible. It's likely that the company does have some payment flexibility for policy owners during the pandemic, but don't assume that it's automatic, as it may require a policy-specific request to be submitted. Beyond the individual insurance company's response to grace period extensions and premium flexibility provisions, numerous state insurance departments have also enacted more broad lapse protection for policy owners of policies issued by carriers in their specific states. For example, in New York, the state hit hardest by COVID-19 has mandated grace period extensions to 90 days and waived late payment fees during the 90-day period. They're also allowing premiums due but not paid during the 90-day period to be paid over the course of the following year in 12 equal monthly installments. And they're also extending the period to exercise policyholder rights and benefits to 90 days as well. So much like was mentioned about the individual insurance companies, as trustees, it's really important to know how an individual state may provide additional protection and relief options right now. While they may generally be the same from state to state, the guidelines and timeframes are not. So we must pay attention and know the specifics of the policy in question. This will obviously continue to be a fluid situation as we move forward into May and beyond, so it becomes even more important to stay informed and know what the carriers and states are doing. As mentioned already, we're seeing an uptick in questions from grantors as it relates to gifting to pay premiums. As trustees, we must know the policy implications of a reduced or missed premium payment. I think the most critical question to be answered here is whether the policy even has premium flexibility, or does the full premium amount need to be paid to avoid policy lapse, such as in a term policy or a guaranteed universal life policy with little or no cash value accumulation. Assuming a reduced or suspended premium amount is a viable option, this inevitably means that we will be requesting a lot more in-force illustrations in the coming months as we evaluate funding alternatives to determine the best course of action for the policies. With lengthier carrier turnaround times possible, think through the potential options before making illustration requests. Understanding the grantor's funding intentions will help narrow the options and focus the analysis. Questions to ask: is this just a temporary financial hardship due to the pandemic, and it's likely that premium payments can resume next year or maybe in 5 years? Or is this a permanent suspension of payments, and now we must determine the best course of action and the best possible outcome in light of no further premiums being paid? An example: for a lapsing policy on a client, say in their 80s, it may be important to see an illustration showing how much an annual premium needs to be paid to maintain the current death benefit to, say, age 90 or 95. However, this scenario is irrelevant if the grantors and beneficiaries are not willing or able to make any further contributions to pay premiums. A more useful illustration request would be to see how much the death benefit would need to be reduced to, assuming no additional premium, to maintain coverage to the same age 90 or 95. Along those same lines, we've seen an increase in requests from grantors to take loans against their trust-owned policies. These loan requests may be for a number of reasons: to pay premiums, potentially trustee fees, or even a beneficiary's health, education, maintenance, and support. A note about whole life policies here is they're probably the most common policy type that allowing policy loans. Whole life policies likely have an automatic premium loan provision, APL. Regardless of your position on taking policy loans to pay premiums, it's a good idea to verify this option is active on all policies with the provision. If nothing else, it will serve as a safety net. When active and an inadvertent premium loan is taken because of a missed premium payment, the full death benefit will remain intact. The less favorable outcome, if APL is not active, is likely a permanent reduction of the death benefit to a reduced paid up amount. Keep in mind, loans can always be repaid. Death benefits cannot always be restored. Prior to taking a policy loan, as trustee, we should be requesting and reviewing policy illustrations to see the impact of the strategy. Simply calling the carrier to ask a customer service rep if a policy loan can be taken is not enough, because we will likely not see the full picture. For example, it may be possible to take a loan or allow APL on a term blended whole life policy, but doing so may significantly affect the term portion of the policy, meaning an immediate and potentially significant permanent decrease in the policy's overall death benefit. This is likely not the outcome we were going for, so we must understand the implications of any premium offset strategy before any final decisions are made. And as with any policy decision that decreases the overall value to the trust, communicating outcomes with the grantors and, more importantly, the beneficiaries is critical. Seeking the understanding and acknowledgement of a beneficiary in these circumstances is a must to mitigate potential liability, now and in the future. Let's take a moment to talk about variable universal life policies now. Variable policy performance, as you likely are well aware, is tied to equity markets. And because of the market volatility that we've seen recently and will continue to see in the future, likely, we should be reviewing any and all variable universal life policies in our portfolios right now. A few questions to ask about each variable policy in our purview. Is the current sub-account allocation strategy still appropriate? How have the current sub-accounts been affected by recent volatility? What other sub-account options are available for this policy? Is the current premium still sufficient to meet policy goals based on realistic hypothetical rates of return? How has the policy performance and projections been affected? And lastly, what are the policy's fixed account or guaranteed interest account options? We should be prioritizing our variable policy reviews by projected lapse date, starting with any policies that are projected to lapse within the next 2 years. With little cash value accumulation, these policies were already in danger of lapsing and will be more impacted by negative rates of return. With this group of policies, we must be prepared to take swift action to preserve any remaining policy value. As a general fiduciary best practice, having investment procedures for variable policies is critically important and will dictate whether a change in sub-account allocations is warranted. Stick to your investment strategy and be careful not to make nearsighted emotional or reactive decisions based on market volatility. The final area of focus is simply a reminder on the importance of proactive client communication. During these challenging times, I don't think this can be stressed enough. Effective life insurance policy management and risk mitigation requires involvement from grantors and their trusted advisors. And when decisions potentially decrease the overall value of the trust, it's necessary to include the trust beneficiaries as well. Communicating with the grantors early and often during the gifting process will ensure adequate time to address any concerns or challenges they may have with making a contribution. When policy changes are being considered, we should be clearly communicating options to all interested parties to ensure best possible outcomes and limit fiduciary liability. Reviewing and communicating policy performance is something we should all be doing already, but it becomes even more critical during times of economic uncertainty. Doing so will reassure clients of our value as a professional fiduciary. This is really our time to shine. So with that, we'll recap the 12 things that we should be focusing on right now as trustees of life insurance. 1, remember, our fiduciary duty is to the trust beneficiary, not the grantor. 2, the grantor is to have no incidence of ownership, and we should not be allowing them to make or influence decisions as if they were the policy owner. 3, if possible, provide grantors with extra time to contribute to pay policy premiums. 4, be prepared for trust beneficiaries who may for the first time decide they want to exercise their right to withdraw present-day gifts made to the trust. 5, process incoming mail daily and identify premium due notices immediately. When a premium payment is sent to the carrier, call to confirm the money was received and applied to the correct policy. 6, be prepared for an increase in carrier service request turnaround times and adjust planning and expectations accordingly. 7, it's important to understand what carriers are offering right now with respect to grace period extensions and premium deferral programs during the pandemic. And along those same lines, 8, it's important to know how the individual states may provide additional lapse protection and relief options right now. 9, we should expect to request a lot more enforced illustrations in the coming months as we evaluate funding alternatives to determine best courses of action for policies. 10, be prepared for an increase in requests from grantors to take loans against their trust-owned policies. 11, we should be reviewing any and all variable policies in our portfolio right now, starting with any policies that are projected to lapse within the next 2 years. And lastly, 12, proactively communicate with all interested parties to ensure best possible outcomes and to limit fiduciary liability. Thanks for your time and attention this afternoon. As a reminder, you can download this presentation and view past webinar recordings, as well as see a schedule of all upcoming courses and register at itm21st.com/education. Plugging Michael Brohan's session again in 2 weeks, an insider's guide to life insurance in a challenging environment. Mike will do a great job of doing a little bit of a deeper dive on some of the policy management specific points than we did here today. You won't want to miss it. And for those of you who don't currently subscribe to the ITM 21st blog, I would highly recommend it. We have a very active industry blog delivering a broad range of timely and relevant content for professionals, trust professionals, and financial service and life insurance professionals. And you can sign up to receive that blog directly to your inbox at itm21st.com/blog. And with that, we can open it up for questions.
Aaron, this is Leon. I just wanted to see if you've had any inquiries via the online question box, and then also if you had any follow-up comments or narrative to John's presentation.
Yeah, thanks, Leon. We do have a few questions, and I'll read through those here in a bit. Thanks, John. Great job going through all these items. I did have a couple things just to add in, and then can open it up for these questions. But on the remediation side, the administration side, the one thing that we're dealing with, along with many, but dealing with carriers, one thing that we do see, as John had discussed, is slower processing times with carriers. So to allow more time for carrier requests, which may be policy changes, dividend option changes, requesting illustrations. A majority of the carriers that we have been working with, most staff is working remotely as well. So processing time, and they may not have access to the normal systems or requests that we find. So do allow more time there. Number 2 is grantors and insureds. Not so much beneficiaries, but the grantors and insureds have been pretty active with our managed clients on reaching out. I think most or a majority may have additional time on their hands if they're working remotely or sheltered in place. So they have time to review their policies or things that they may not pay as much attention to. So I think it's great to be able to be proactive in reaching out to the clients or the grantors or the insureds to check in and see how they're doing. The second part of that too is we have started to see an increase in requests coming in about surrender inquiries or options that are available. So I do recommend in following that process of going through of all available options when you get into policies, which may be above the scope of this webinar here. But going through that checklist of what to do with the policy, what are your options, what are your no pay options outside of the policy. And
Hey, Aaron, does that dovetail to what you and Mike are going to talk about in a few weeks on life settlements?
Yeah, definitely will. It will get into all the available options, including a life settlement scenario and those options. But definitely walking through those steps and not rushing into surrendering a policy by any means.
Hey, Aaron, can you hear me?
Yep, I can hear you.
Okay, two things real quick. This is Michael Brohan again. Number one, I was on the phone yesterday with a carrier trying to get information, and one of the little tapes they played while I was on there said that if I have an urgent request, that I could email them and they'll get back to me within 3 to 5 business days, which I thought was kind of interesting, kind of funny that they think that that's what you should be doing with your urgent requests. The other thing, in the next session, I will briefly go through the 7 steps that if you have a policy, the client wants to surrender it, here's 7 easy steps that you can go through to make sure that you maximize the value of the policy. One of those will be life settlements. We're not going to go into it very deeply, but you'll have those steps. And I'll also have an article I wrote that goes into that a little bit deeper. And then, as Leon mentioned, we'll talk about life settlements in detail, which, if trustees are surrendering policies without at least looking at a life settlement, making that part of the trust file, there could be issues down the road.
Okay. Thanks, Mike. I'll go into reading a few of the questions we have. If we don't get to your question during this time, we will respond via email and make sure we get an answer back to you. The first question I'll read, what are the expectations of carriers to keep guarantees in place while extending grace periods? That's a good question. That's one that we've discussed internally. Not all carriers have been sending correspondence necessarily that the grace periods are going to be extended. It's been very one-off. We have, I think, 14 carriers that we have confirmed in one way or another that they are extending the grace period. The expectation is that the policy would remain unaffected by a late payment, assuming that it's within that extended grace period. That being said, we'll have to see exactly and following along closely with what type of policy it is, if it is a guaranteed UL or a guaranteed variable type of policy, how late the payment is, if it's going to be late, and reaching out to the carrier proactively to discuss the timing of that premium, make sure they have the file noted on their end that it's going to be coming in. It may be X days late, and then just walking it through that way. But up to this point, expectation is that the policies will remain as they should be if the carrier is extending that grace period. The second question I'll look at here, how does an independent agent obtain information from a carrier which may be particularly obstructive in working with someone other than the specific agent, if it was a captive agent, even if the client has so requested? So I think in these scenarios, when you have a potential carrier or an agent that may be unwilling to give information, working directly with the owner, whether that's the insured or the trustee, getting a signed third-party authorization if able, generally frees up and allows you to get the information needed. There may be some that drag their feet a bit on getting the information out, but that being said, if you are calling into the home office and you do have authorization or the owner insured on the line, you should be able to gather what you need. Third question that I have here, and this one, Mike, may be a good one for you to weigh in on. Are you seeing any increase in TOLI lawsuits as a result of the extended low interest rate environment and the failure of policies to perform based on illustration?
That's an interesting question. And since I left full-time with ITM, I've been doing some consulting, and I've come across a couple of cases. They're not necessarily lawsuits in the sense you're going to see them in the paper, but I've come across a couple of very, very significant cases that trustees have been sued because of non-performing policies that they did not keep their eyes on. I don't know what the outcome will be, Aaron. Like I said, I don't think either of the cases that I've dealt with are going to go to court. I think they're going to be settled out of court. But the problem is that the non-performance over the last 10 years is starting to really catch up on some of these policies. So now's the time to keep your eye on all the policies in your portfolio. And I think also that when you talk about communication, that's a key too. And making sure that the grantors understand that the issue is the interest rate environment, not anything that the trustee's doing.
Sure. Thanks, Mike. Next question I have, because we do have a few minutes left here. I have an ILIT with a term policy which is coming due next month. It looks like it's approaching the end of the level period. Should add that there's no cash in the trust which can be used, and the grantor is not wanting to fund. So the process that we follow, and we'll get into more in the upcoming webinars as well, is making sure that the beneficiaries and all parties, if there's co-trustees, are aware of the options available with that term policy. One being the increased premium amount that can still be paid to maintain that policy. So if you had an insured that was in poor health, it may be beneficial to pay that premium, even if it is pretty substantial. The second is looking at conversion options. Is the conversion feature still available? If so, you can work directly with the carrier and the home office and agent if still involved on reviewing the potential options or conversion quotes for the different products that are available. Oftentimes, if that conversion option is still active, you may be able to move to a permanent plan that would be less expensive than the increasing premium on that term policy. So I would recommend going through that, and then just making sure everybody, especially in today's environment with COVID-19, that the insured is healthy and making sure all are aware of the options, including that increased premium.
Very good.
Does
that wrap up? Does that wrap up the questions?
Yep. There's a few more out there, but we can reach out directly to the asker and get those questions answered.
Well, very good. Well, again, this is Leon Wessels. I want to thank everyone for registering, for joining us today. You're probably a little rusty. It's been a couple of years. We'll try to get this machine oiled up, and we'll get you some great content, some great speakers, get you some continuing education credits. Your input is important. Feel free to email myself or John or any of us that you may have contact with. If you have suggestions for topics in the future, we'd love to hear them. And with that, we want to thank you again, everyone, for your time. Until we meet again, be safe, stay healthy, stay wealthy, stay wise. That's it. Bye.